Hello and a warm welcome to Econoday Unplugged on Wednesday, the 14th of July 2021. Mark Pender is stateside, along with, I'm delighted to say, the redoubtable Terry Sheehan, a new voice for Econoday, and I'm Jeremy Hawkins in London, where yet again last Sunday, football didn't quite come home, sob. Anyway, it might now seem that the idea of a reflation trade, in which investors scramble to sell bonds in anticipation of the recovery from the coronavirus, driving up inflation and ultimately interest rates, is, well, passe. Inflation has risen and shot in many countries, and yet since mid-May, bond yields have declined pretty well everywhere. Indeed, the US 10-year is back at levels not seen since early March. So central banks seem to have convinced investors that the current dislocation between demand and supply will only be temporary, and that as global output picks up, so price pressures will begin to subside. However, that's just one scenario. An equally plausible alternative is that demand continues to outstrip production as the rapidly spreading Delta variant further disrupts the supply of raw materials and the output gap just widens further. In that case, expect inflation to climb higher and remain above target for longer. The bottom line is that there's still so much uncertainty about how COVID will unfold that it's dangerous to make any firm assumptions about where inflation is headed over the medium term. In other words, it's probably best not to write off the reflation trade just yet. And talk of inflation, amongst a veritable wodge of key US data this week, yesterday saw another CPI shocker, this time for June. So Mark, and indeed, and Terry, just how bad was it? And could it yet shift Fed policy at the July FOMC?
If I may, Terry, it may shift policy, but it sounds as if Jerome Powell, who's speaking today at noon, taking questions and answers in Capitol Hill, he gave his prepared text at 8:30 this morning, and he seems to be holding tight that this inflation scare will just be a scare, and that it'll ease back, still holding to the one-time thesis. And whether or not, as we saw in the last FOMC, where they had the economic projections, those were telling a different story than Powell. They were telling a story of concern among the 18 members of the FOMC that inflation may be getting a little bit more heated than they thought. But he was playing the other side of that. But at the same time, when he was doing that, he was citing in a contradiction of sorts. He was citing their inflation forecasts as opposed to their interest rate forecasts, that inflation would indeed come down. So I think he was playing both sides of the fence there. Whether or not he continues to do that, you will see. I mean, the CPI that came out yesterday, it was 0.9% at the headline. That exceeded Econoday's consensus range by 0.3. So that is quite, and that is a very, the forecasters are very focused on that forecast, and so they put a lot of work into that.
Let me quickly interject, if I might. I mean, it's getting to the stage now whereby we keep saying these US inflation numbers coming in not just a little bit above the market consensus, but they're beating them by some considerable margin. I mean, are we getting to the stage whereby if we continue to see inflation rising and yet Mr. Powell continues to maintain that this is just temporary and there's nothing to worry about, the Fed is going to start losing some of its credibility?
Well, except for the balance of the FOMC is playing the other side, which is that this may be more than we think. This may be a little bit longer than temporary, and that's why they penciled in that rate hike in a couple of years from now. That's just the beginning, and that's why they're jawboning that they're beginning to taper. So I think it's a communications effort, good cop, bad cop. I think that Powell is playing one side, and the balance is playing another side, and that's so far they've done pretty good. They got it out that they're going to be tightening, but it hasn't totally jolted the market. So this is maybe a layered approach. Whether it's intentional, that's another issue. But you're right. I mean, and it's the monthly increases that are so severe. It's the annuals we expected because of the easy comparison with this time last year when the lockdown was holding down prices, but now it's taking off. And before I go on too long, I want to bring Terry in here, but I just want to, say in your introduction, Jeremy, in the U.S. we're reopened. I mean, and I think in the U.K. you may be just judging by the images I see. You look to be less reopened than we are. So I think we're getting that reopening play right now, and if that follows along in Europe and then subsequently in Asia, we could really have quite a lot of inflation. Anyway, let's ask Terry, who actually read Jerome Powell's text this morning. Terry joins us. We were old colleagues in Market News years and years ago, and then she moved on to Stone McCarthy and worked out of Princeton, and she's a pro at this Fed stuff. So tell us what you think.
Well, thanks, Mark. I think we have to remember that the Federal Reserve, when they're setting policy, they're doing it on a longer time frame than just a couple of months here. And as severe as we've seen the price increases in the last few months, I think we're going to have to look for a more sustained basis. The numbers we see are pretty big, but it's very specific things like motor vehicle prices. And I personally rather trust the Fed on the issue of their inflation forecast, because they tend to be pretty good about this. But I do think it's important to keep in mind here that the US Central Bank, at least, is looking at a fairly long time frame. But that's not to dismiss that they are very vigilant on this. So I think, if we see another month or two of these kinds of really strong price rises, we might have to look for the Fed to start pulling in some of their forecasts for when they're going to have to start tightening policy.
Okay, let's come at it from a slightly different angle. It's not to say a different angle, but something which has become more and more apparent within Europe, not for necessarily all of Europe, but certainly in some of the larger countries like Germany, France, and indeed my side, the UK. What we've seen since the arrival of the coronavirus, if we go back to the pre-pandemic months of February last year, there's been a relatively rapid recovery coming through in domestic demand. And here I'm just looking at retail sales because we get those numbers. We're slow over here, and we've actually got some figures on retail sales for May. There's also been a relatively muted recovery coming through in industrial production. So we just simply proxy, what's going on with supply and demand using those two variables. Then there's a fairly substantial, if you like, growth of excess demand appearing in Europe. So, I mean, just in terms of the Eurozone as a whole, is currently running at around about 5 percentage points. So, retail sales have grown 5 percentage points more than industrial production has since the recovery started. In countries like Germany and France, we're well into double digits. The UK is running at about 13% or so at the moment. So I wonder, if we really need to looking at the output side of it, things need to accelerate there to close the gap in order to ensure that potential underlying inflation trends don't start getting out of hand, on top of all this stuff we have going on with raw materials at the moment. Is that sort of true your side as well?
Oh, well, if I may, Terry, it's
Yes.
Well, we have the supply snags, and that is driving. We have producer prices this morning, which gets right to that point. And just like the CPI, beyond Econoday's consensus range, 1% monthly gains, both overall and when excluding food and energy. And this is, part of, Powell will say, well, the supply snags are temporary. That these will all fade as the supply chain catches up. And but in this report, it was quite astonishing. Here Terry had talked about the auto sector driving up consumer prices. Well, in the retail sector in the auto industry in June, their margins, this is how they measure it, shot up 10.5% in the month.
Yeah.
So that is a gargantuan amount. So even if it's isolated, it's severe. And Jeremy, haven't I been seeing car prices accelerating in data out of Europe?
You most definitely have. And again, it's partly a reflection of the fact that we've got this raw material shortage going on at the moment. A lot of would-be purchasers of new vehicles haven't been able to get hold of new vehicles, or at least there's very long waiting lists because the manufacturers themselves can't get the semiconductor chips or wherever it may be to produce the things in the first place. So now that, as you mentioned, we are reopening. I mean, our so-called Freedom Day is supposed to be next Monday, so we hope that goes well. But yes, there is a lot of demand out there, but instead of going on to new cars, a lot of it's gone on to used or second-hand cars. And that, indeed, we had the Consumer Price Index out of the UK earlier on today. And one of the main reasons why that, a bit like your side, came in significantly above expectations was because of a big increase in prices of used cars. So it comes back down to this thing. We've got a relatively strong recovery in demand, but the big issues on the supply side, which I'll move on to the ECB shortly, but it makes it kind of problematic, I think, for some of these central banks. So the ECB's sitting there looking at these economic numbers, and on the whole, recovery doesn't look too bad, but it's the composition which is giving it the big worry, because demand is so far ahead of supply. And the worry, I think, is that because particularly in Europe now, the UK in particular, we've got this huge expansion of the Delta variant, notwithstanding the fact that we got this Freedom Day next week. It's also starting to spread across continental Europe now. So the likes of Spain, Greece, they're starting to see fairly big increases in their COVID numbers as well. We got the big issues as well coming out of Asia, where COVID is a real problem still. So I don't know, I suppose I get negative, and I kind of wonder how long, it's easy to say, well, these are temporary supply bottlenecks, et cetera, they won't last too long. But in actual fact, I wonder if they might last rather longer than some central bankers are thinking at the moment.
Why, let me ask both of you, let's just ponder for a minute. Why is there such an urgency to buy cars? Cars are not something that usually require an immediate decision. And why all this sudden demand? I would just like to, at least in the US side, that it has to do with low interest rates and extreme amounts of emergency stimulus, whether fiscal and including the monetary as well. I mean, what do you guys think?
Well,
Terry, ladies first.
I would say it's in part a product of the pandemic when, people were staying at home. They didn't need their cars. And all of a sudden, they're now out and about again. A lot of jobs involve delivery services. So there's much more need for transport right now. So I think we had some pent-up demand going on. And also, as you said, interest rates are low. So this is a good time to buy a car if you can, if you're going to go new or even used. But I think it's just, at least in the US, I just think it's this resurgence in consumer demand. But I also think that we're going to see drops in auto sales in reaction to these price increases.
That's a good point, Vince. What happens when people do start adjusting these price rises? But yeah, I mean, I'll go along with all of that. I certainly think, as far as Europe's concerned, and particularly the UK market, I mean, quite simply, the bottom fell out of the auto market in Europe as far as 2021 was concerned. I mean, sales were down 90% plus or so. So there's an awful lot for the market to make up as far as this year's goes. And of course, as we start to have the economy reopening again, there's been the opportunity for would-be buyers to go out and purchase. But as we said before, the supply issues are preventing the purchase of used cars. So there's kind of like excess demand, particularly strong excess demand going through in the second-hand market. But yeah, the rest of it, I think, interest rates, wherever you look, interest rates are through the floor. So if you do believe they're going to have to go up at some point, perhaps now is a very good time to do it. And of course, when you're looking at savings rates, pretty well, right across the industrialized world, saving rates are either at or extremely close to all-time record highs. So there's a lot, there's a lot of money around to actually facilitate the purchase of cars, or indeed, anything else. We'll have to wait and see, as these economies continue to reopen.
So both houses and cars are having a demographic effect, a change in in the population because of the pandemic. One at housing because of having to or wanting to move out from a congested area, perhaps, and cars because what Terry was saying. The greater distances to work, perhaps, and also a greater delivery demand. So these are these going to be permanent features now?
Well,
anyway.
UK, if you leave some of the big, the mortgage lenders in the UK, they're saying precisely that at the moment. Okay, we've had things like stamp duty holidays and the like in the UK, which have certainly encouraged demand. And indeed, they've done so very successfully. But the actual guys who produce the numbers, the surveys they're undertaking, quite strongly suggest that it is a structural shift in demand. We're seeing property prices in London typically come down for flats, apartments, call it what you will. Prices of rural areas really are going up extremely strongly. And that seems to be as much to do with worries about the coronavirus in whatever shape or form, as to do with anything else. So yeah, it's going to be interesting to see how whether or not we do start to see some kind of gravitation going back into the likes of the City of London, or indeed we're going to end up with an awful lot of empty office space.
Did you guys see Larry Summers' comments? The former Treasury Secretary. You didn't catch him, Terry?
I didn't. No.
You didn't? Well, he's talking about that inflation is and overheating is the risk right now, and these kind of numbers point that out. Terry, now you're going to be watching Jerome Powell's testimony.
Yes.
How do you think he's going to downplay? I mean, Larry Summers, the economist of his generation, that kind of thing, who's on the other side, and there is certainly some. Well, we had Bullard, I guess, and I don't know all the FOMC members who are now in line on that kind of overheating risk kind of thing. But how do you think he's going to address that?
I think he's going to stick very much to what he said in his prepared remarks today and what the Fed put out with the report to Congress last Friday. I think we have to remember that Powell speaks for the FOMC as a whole, not just himself. So he has to be extremely cautious about this. I do think he's going to get a lot of questions about inflation today. Pardon the pun, it's a hot topic. But I think he's going to stick with this moderate, long-term, vigilant language about inflation, because there's just, Fed chairs generally do not like to be alarmist in any respect. So I expect very not mild language about the current pace of inflation, but I expect him to offer reassuring language.
Well, what happens if he gets questions like, what did the Bank of New Zealand do today? Or what did the Bank of Canada do today? I mean, is the Fed getting behind the central bank curve? What do you think, Jeremy?
Well, I guess you've got to take each individual country on its own basis. I mean, in the past, you go through economic cycles and a lot of central banks tend to look at what the Fed's doing, and most investors will assume at some point, the other central banks are going to have to follow it, particularly given the importance of the dollar and so on. But I think at this stage, there's quite clearly a belief amongst some central banks, I suppose we should just quickly mention that the Reserve Bank of New Zealand, they've now come out and announced that they're going to end their quantitative easing. We know that the Reserve Bank of Australia, they've also started tapering. As of today, the Bank of Canada announced an additional tapering, so it's getting quite close to, it would seem now, to the point where it actually ends its quantitative easing program. So there's a number of central banks now which are at least starting to go down the path towards some sort of policy normalization, irrespective of the fact that it seems from everything you're talking about that the Fed is in no hurry to do anything. It's actually quite interesting. But if that is going to be the case, then presumably it will have implications for the dollar, but just more generally, it's quite unusual, I think, to see this kind of the disconnection between the US monetary policy cycle and what's happening in other parts of the world. So yeah, it's going to be quite fascinating. But I think at this stage, obviously for the emerging markets, they've got to keep an eye on what's happening to Fed policy and what's happening to the currency. But I think for a lot of other countries, they're kind of sort of heading down their own route now.
So you see this as dollar bullish?
Well, I think if not ultimately, no, I think it could.
No,
It could,
dollar bearish. I mean,
it could ultimately be dollar bearish. I think at the moment, of course, it's still when you look at the major currencies, if you just take dollar, yen, sterling, and the euro. Well, dollar, if we assume policy isn't really doing a great deal at the moment. In the UK, one reason why the pound has been very strong is because the numbers here have been particularly good, the vaccination rate high, and speculation is that the Bank of England is going to have to push interest rates up before they're kind of intimating at the moment. But again, for the likes of Japan, well, nothing's going to happen in Japan for the foreseeable future, it seems. And then you get to the euro, and the thing that's in favour of a dollar at the moment is that the ECB is one of those central banks which is very much in the camp of the Fed, if not even more dovish, in the sense that we had Christine Lagarde, the president, talking again yesterday and I think this morning, reiterating this view. Look, we think inflation's going to go up, but it's going to come back down again because it's only transitory. And then other things which before we prattle on for too long, I suppose I should just quickly introduce. Last week, they made a change to their inflation target. Not a huge one, but it's a little thing which makes it easier for them to keep interest rates down and policy as soft for as long as they can do. So rather than aiming to target inflation, at close to but just below 2%, they've now switched to an out-and-out symmetric 2% inflation target. So in other words, they've raised the target a little bit, not a lot, but at the margin, it does suggest that they might be able or willing to keep interest rates lower or quantitative easing going for that much longer than previously. So they are still very much in very accommodative monetary policy mode at the moment. So I think when we look around the currencies, there could well be, if we keep going like this with different central banks doing different things, it's going to make for a very good time for currency market traders because it should start to introduce some much needed volatility.
Well, you had mentioned the question of focusing on the emerging markets now. But a soft dollar would be favorable to them, no?
Yeah, most definitely. And the last thing they want is Powell to change his mind and say, "Okay, I've got it wrong. Let's come out and raise Fed funds rate by 0.5 percentage point." Because the emerging markets will, well, not to put it too technically, but take a right stuffing on the back of that. So a soft dollar for them is excellent.
If I could interject here.
Yeah, please.
I think that the Fed will not be raising rates for quite a while, but I would not be at all surprised if at the FOMC meeting 2 weeks from now, they seriously consider starting the taper of the asset purchases and that Powell uses the opportunity of the Jackson Hole conference in August to send a signal on that.
And that's it. It does. It comes classically down to communications, doesn't it?
Yes, it does.
Baby steps. It's just drip, 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 feed it into the market. So when it happens, oh, big deal. We knew that was going to happen anyway.
Well, so Terry, when do you think they're actually going to make a number on tapering?
I don't know, but if we look at what Powell said today, he was talking about them giving advance notice. And although I'm sure he wouldn't agree with the language, I think they are starting to think about doing this. And my sense is that there is, from the last FOMC meeting minutes, there is enough concern among various policymakers that it's getting to be time to start reducing the asset purchases. I just would not be at all surprised if the next FOMC meeting sees a strengthening of that sentiment.
Let me ask you something. And you may think this is totally ridiculous. Don't come out with such a ridiculous suggestion. But is it possible, you think, that the Fed, when it comes to quantitative easing, could actually go to a more qualitative rather than a quantitative view, in the sense that if we look at the ECB, they have a number of different asset purchase pots. So the main ones are so-called PEP. They also have the asset purchase program, which has been around forever. But the focus is on the PEP. When they decided to increase purchases under the PEP, back in March time now, they didn't come out and give any kind of definitive number. They just said, right, we will be increasing PEP purchases significantly higher than they were over the first 3 months of the year. Do you think that's anything like the Fed might consider, rather than saying, well, look, we're going to reduce mortgage-backed security purchases by X, we say we're going to start reducing them, full stop, and leave it like that?
I think they might want to do that. They certainly talk in terms of things like a substantial improvement in the economy before they begin to taper, and that's kind of vague. What is a substantial improvement? But I also think that traditionally that the treasury markets in the US are used to dealing with these numbers as the way that they deal with what the Fed's decision is. So although they might use as a signal, say that we are going to, substantially reduce our purchase of MBS or something, when it comes down to the actual announcement, I think they're going to stick to hard numbers.
What's interesting is that the Fed people have been getting questions from the press on whether or not the MBS purchases are going to be targeted first because of the housing. I'm going to say because of the housing bubble. I mean, but the risk of a housing bubble. But that's kind of interesting to me. I mean, isn't there an overlap? I mean, is it, what is the relationship exactly between a mortgage rate and the MBS market versus the mortgage rate and the treasury market?
Yours.
Well, they used to base market on the 10-year treasury note,
Yes,
right?
that's right. Yeah, definitely.
So, and they wanted to protect liquidity in the mortgage-backed market, but that has been doing fine. So I'm not sure that you can split it like that. Maybe you can. I don't know. It'd be interesting to see.
Well,
I think some of the initial decision to start purchasing MBS in the latest round was to protect the housing market that was clearly having difficulty early last year, and now it isn't. So that could be one of the factors they take under consideration.
This is all excellent stuff. Sadly, I think we're probably getting towards the end of the podcast since we've been talking rather a long time. But before we go, we'd just like to mention, because we've been talking about in the context of what monetary policy cycles and the like, by and large, it kind of looks as if for most countries they're either not doing too much for the time being, or they're gradually starting to move towards the direction of at least less accommodation or ultimately some form of tightening. Well, it's not like that everywhere, quite clearly, because last Friday the People's Bank of China came out and announced that it was cutting reserve requirements, and it's quite a big move as far as they're concerned. It's the first time we've seen this RRR, as they call it, cut since the worst months of the pandemic last year. Now, the official statement presented it as really just a technical move. It was due to improve liquidity because a number of medium-term lending facilities are due to run off come the end of this year. But ultimately, it really kind of suggests that they really do want to allow banks to step up their lending, because there have been recently some signs that economic growth may be starting to slow. Now, if that is the case, then we could well be at the start of some kind of easing cycle coming out of China. And including if they are easing, it's because that part of the world isn't doing so well.
Well, their data has been slowing, and the Canada's consensus, where they're coming up with a run of their monthly data, including quarterly GDP on Thursday Chinese time, and it's all more slowing. I mean, it's still mostly double-digit growth, at least for industrial production and retail sales. But actually, let's see. We also like to talk about our Econoday calendar. And let me just check here what the Econoday consensus is for Chinese GDP. This will be second quarter GDP. And it's year over year, 8.2%, and that's down about 10 percentage points. But still, quarter over quarter, it's going to accelerate according to the consensus, 1.3 to double from 0.6. So that would be a mixed result. But in any case, things are slowing over there, and it's a whole different COVID world over there, isn't it?
Well, it's interesting. Again, it comes back to sort of dislocations we got potentially in policy cycles, and the economic cycles as well. And so long as if you do have, let's say, a country the size of China really starting to slow, then China was one of the main reasons why the global economy at least kind of kept it, well, it didn't keep its head above water, but did a lot better than it could have last year because of the early recovery in China. China starts going the other way. Perhaps the US and some other countries can fill the gap, but perhaps it means that overall global inflation pressures may not be as much as they could have been had China still been in boom mode. Okay, right then. I think then that probably ought to be it for today before we do go on for far too long. So let's wrap it up there. On behalf of Terry, Mark, and myself, thanks as ever for listening. We'll be back next week when we'll be joined by our Asian expert, Brian Jackson, who can fill us in on what really is happening in China. So please do join us then. In the meantime, as ever, you can find all the key market moving data and events listed and analysed in Econoday's global economic calendar. We'll see you next time. Bye for now.